Our next panel is Opportunities in Real Estate and Direct Lending. The moderator for that panel is Mr. Eduardo Alves, Director, Risk Services, S&P Global Market Intelligence. Eduardo.
Hello, everyone, and welcome to the Opportunities in Real Estate and Direct Lending panel. During the next 55 minutes or so, you will hear from leading investment professionals about real estate investment opportunities, particularly for direct lending. We aim to cover a wide range of topics, including the current condition of real estate market in light of COVID-19, the role of direct lending, key considerations when investing in real estate, credit risk issues, and provide a market outlook. We reserved the last 15 minutes of the panel for a Q&A session, so we urge you to engage us by submitting your questions. My name is Eduardo Alves. I'm a director in the Credit Risk Solutions Group of S&P Global Market Intelligence. My team provides the tools that credit and investment professionals rely on to make risk assessment, underwriting, and pricing decisions with conviction. Our commercial real estate scorecard is a powerful credit risk solution for both in construction and income-producing commercial real estate, be it multifamily, industrial, residential, retail, office, constructions, hotel. My background is in credit risk, stress testing, commercial loan origination, consulting, and econometric research. It is my pleasure to moderate today's panel and introduce you to our distinguished panelists. Please join me in welcoming Nick Eskandari from KeyBridge Fund, Rob Jaffe from Boomerang Capital, and Eric Newman from City of Stamford. I invite each panelist to take a minute to introduce yourselves and your companies. Nick, we'll start with you.
Good morning, everyone. My name is Nick Eskandari. I'm the president and CEO of KeyBridge Capital, which manages a commercial real estate debt fund structured as a real estate investment trust, or REIT, to investors. The mandate of KeyBridge is to make short-term bridge loans, typically 12 months term, secured by commercial real estate in first lien position in select prime locations of the United States, with a primary focus in California, with no more than 50 to maximum 60% loan to value.
Thank you, Nick. Rob?
Hi, I'm Rob Jaffe from Boomerang Capital Partners. We run a single-family residential focused REIT. Our exposure is focused in Arizona, Colorado, and Texas. We've been doing it since 2006. Our current fund was started just about 3 years ago. Some of our real differences: we originate our own loans. Most other people are purchasing them off the internet or participating in secondary markets one way or another. We underwrite, a lot of other people underwrite. We service our own loans. We maintain and service our own loans. And we actually think about it as a portfolio. Everyone's interested in what returns look like. Our returns are quite steady. It's a steady business, and that's what we do.
Fantastic. Thank you, Rob. Eric.
Eric Newman, Treasury Manager with the City of Stamford up in Connecticut. I'm also serve as a trustee on several of the pension investment boards. Our combined assets under management is $775 million. We invest across the board in public equities, public debt, as well as alternative investments, hedge funds, private equity, private credit, as well as real estate and infrastructure.
Perfect. Thank you very much, Eric. Thank you very much, three of you, for joining the panel today. Following Jesse's great presentation, we know we live in extraordinary times. All real estate property types are affected one way or another by the COVID-19 pandemic. S&P Global Ratings research indicates that multifamily, industrials, and data centers appear to be more resilient in the current environment. But meanwhile, retail-oriented assets, particularly malls, they look set to take the brunt of the decreasing rental payments. severely impacting their cash flows. So just to put into perspective, still according to S&P Global Ratings research, last April, the average rental collected in percentage terms was in the mid-90s for rental housing. Okay, it was down to 60% for strip malls and down to only 20% for regional malls and outlets. Okay, the long-term future of office buildings is also uncertain as the social distancing rules and increased work mobility put downward pressure on demand for office space. And our expectation is that lease renewals will be marked by very tough renegotiations. These are global trends, not something that we observed only in the US or European markets. It is something that we also experience and see certainly in Asia Pacific. Okay, so against this backdrop, okay, my first question to the panelists is about the state of the real estate market. Okay, Eric, why don't we start with you? If you can just elaborate a little bit on what you think the current state of the real estate market is, a little bit of the impact of COVID-19, and your outlook.
Sure. It's a challenging the real estate market. We're seeing, working in a government, we're seeing delays in potential, offices are closed. Retail is suffering, as well as a lot of restaurants, and these are going to have a long-term impact on the real estate developers and asset managers, because while initially there's a tremendous amount of stimulus coming in, and central banks around the world are keeping the rates very low to help navigate through everything. It's going to eventually come back, and things are going to be challenged going forward. There is opportunity, on the other hand, for different areas that probably weren't on the forefront of institutional investors previously. And as an institutional investor, we're looking at different opportunities. While looking at data centers, cell towers, those are things that we know that are going to be producing cash in all weathers. Other areas of the real estate market, we know that we want to probably loosen up on our positions and try and navigate through the next year and a half until things really start to turn a course on what's going on.
Thank you. Rob, any comments?
I think our world, is a little different as far as we see the current outlook. At the end of the day, real estate lags. It's a lagging indicator. As things change, it takes a little while. And there's very much some specifics this time that are going to continue that. We need to very much differentiate our world and some of the others. Ours are business purpose loans. So all of these sorts of programs and things that you're seeing to help on with mortgage deferrals and those sorts of things in the 90% rental collections, those don't apply to us. We'll still see them. There's still problems. We're not seeing a significant change in our portfolio. About 1% of our portfolio we're going to have issues with. That's not changed. So really what we're thinking about as far as seeing is you're going to see your hit and you're going to see the downturn, and then you're going to see this kind of cascading effect that'll take some period of time to resolve, and then you're going to see the new normal. As far as the way we're seeing single family residential, about 20% or so, depending on how you count it, of the real estate market goes to investors. Those investors, we're going to see some of that held going back into the banks. That'll take some time to resolve. That'll be relatively quick, probably by end of year. The longer term stuff, the stuff that's not held by investors, the stuff that is held by users, that 80%, that'll take some time. The last time we did this, it took about 6 years in total, peak to trough. But the majority, and then you got kind of half the hit in the first 3 years, and then the recovery in the last. That's roughly what we're seeing this time. Probably kind of a 3-year rolling change. We are seeing some definite changes in the end purchaser. So we're the end purchaser which is very positive for us. We're seeing people moving out of urban, desire to move out of urban, especially some of the areas densely served by transit and those sorts of things. And then the millennials, they've deferred home purchases. They haven't stopped. They're never going to do it. Those sorts of things. They've just deferred it. So millennials are coming in. So that's what we're seeing. And one significant caution I would say is when we're looking at things, the real estate market slowing and those sorts of things, it's really a seller's strike here. So we need to be careful when we look at this, differentiating volumes versus price. Volumes are down quite a bit. That's mostly a seller strike. It's not a buyer strike. The buyers, there's still money on the sidelines. There's still people interested in purchasing, but you're just not seeing inventory brought on. So it's really a seller strike. We think we think there'll be an initial hit that'll pretty much be cleaned up by first quarter of next year, and then there'll be this long-term kind of change in ownership that'll keep our volumes. We'll be able to lend into that pretty well. So that's what we're seeing.
Thank you. And Nick, how about yourself? Any impact of the COVID-19 in your portfolio? Where do you see the current market?
We're getting a lot more loan requests. In 2019, we've decided to lower our loan to value to 60% and in first position. We do manage our own portfolio and we make short-term loans. We're seeing a spike in loan requests because we're seeing that a lot of property owners are having to tap into their commercial real estate assets for cash, whether they want to acquire another property in time or whether they want to pay off an existing loan. We're seeing a lot. So look, we've had the longest economic expansion in history. We were expecting some sort of correction. Unfortunately, the COVID-19 really, made that process much quicker. The economy was shut down in just a few weeks. We've got so many people. I want to say last time I checked was 40 million people that are unemployed. It remains to be seen how many of those people are going to go back to work. We've been on life support by the feds. This is going to end soon. The stock market is playing a different music. We don't think that is sustainable. I've seen personally with my management team 3 major recessions and cycles. This one is way different. We are hoping for the best and preparing for the worst. I think we'll be safe by our conservative underwriting guidelines in select strong markets of the United States. This year, our focus is just California and the coastal counties of California, which we are very familiar with. Look, we hope that, no one's got the crystal ball. Who knows how deep this is going to be and how long is this going to last? The good news is that there's so much money on the sideline, and people that haven't been able to get a lot of loan or put a lot of leverage on their assets may be able to survive this cycle. And I think they will. So that remains to be seen.
Yeah, thank you, Nick. I believe S&P Global Ratings economists, expect that on the unemployment front, the number is going to improve to roughly like 5% to the end of the year, but it's going to take quite some time to get it to below the pre-COVID levels of like 4% or below. So let's talk about direct lending. Rob, I'll start with you. What is hard money lending? Why does it exist?
So hard money lending is probably we'd be better off calling it asset-based lending. So we lend against an asset. Banks lend against cash flow. And there's a variety of reasons that they have to or they want to lend against cash flow, getting into the way that they account for their charter and their tier 1 capital versus tier 2 capital, those sorts of things. But they're going to lend against cash flow. They're going to worry about a credit rating. and an ability to pay, they're going to be slow, and they're going to be regulated. Whereas direct lending or hard money lending or asset-based lending, we look at the asset. We might or might not be worried about the credit rating. We generally take personal guarantees and those sorts of things. But we all know that those are not, we'll take them, but they're not great. And we're going to be much faster. And you know, a large part of that is going to be unregulated. So a bank may take 60 to 90 days to approve a loan. We're going to be able to do that in a matter of days or weeks. So those are the main differences. Really, you know, banks kind of can't do it. We can do it. As Jesse talked about, the direct lending after the global financial crisis, banks allowed alternatives to fill their void, and that's what we do. We fill that void because we look at the asset rather than cash flow.
Great. Eric, would you like to talk about the role of direct lending and how it fits in a public pension portfolio locations?
Sure. It's part of the thing of investing in direct loans is you're diversifying your portfolio. You gain a different type of income stream. You're you know, some loans you could get different parts of the capital structure. You're helping make economic development, and by investing or giving loans to businesses that might not have access to the capital, and they want to grow their business, they want to be successful, and they're going to be, you know, they're going to be returning, making returns, making payments, interest and principal, and depending on the different structures. And it's just a cash flow thing. And we're long-term investors. We have to match our assets and our liabilities on a very long term, and gain investing in some of the private credit. We're going to get different income streams. As an investor, it's just we could invest in various levels. We could go the senior level, or we could work our way down to the capital structure, and then we get different terms. And in certain environments, a company might not be doing as well, and we're going to get higher rates. And we have our own internal targets for making matching our long-term liabilities and how we're going to produce income over the very long stream to make future debt payments to our retirees.
Perfect. And Nick, do you think direct lending is a you know, a good option now during these turbulent times to try to achieve above market returns?
I think it's always been a good, you know, depends on, you know, how you structure the fund and what types of assets you lend against. But in this cycle, I want to say it's probably one of the best investments opportunity with the above market return to investors on a very well structured and well organized debt fund, you know, in first lien position. We believe that in this cycle, it's if not the best, is one of the safest. If you're a high net worth individual, where do you want to put your money? You know, the stock market is I think inflated and needs to come down, and I think will come down. You know, CDs and other investments are not giving good return on investments. We're offering 7% pref plus in first lien position with 100% monthly distribution to investors and backed by audited financial statements by a very reputable accounting firm. So yes, we do believe that this is direct lending, a well-organized debt fund. Direct lender plays a very important role, and there's a lot of business, I think, out there on good commercial real estate assets for both the borrowers and the investors.
Yeah, so I'll keep the word with you, but this is a question for the three of you. Okay, so Rob, Eric, please feel free to pitch in after Nick. What do you see as the biggest obstacle for the direct lending market, and how to overcome them?
I'm sorry. Is that question for me, Nick?
Yes.
Okay.
Yes, Nick.
Well, the biggest obstacle is really for us is, you know, if I might say, location and our loan to value underwriting guidelines. We pass on a lot of deals because we believe, it's a challenge to come up with what the value is going to be here from now. We are a 12-month term loan. So we've been very, very conservative in terms of, I don't see any other really challenge because banks, as you all know, are making it even more difficult to lend. It's a 90-day processing for commercial real estate. We're in the commercial real estate space. So I see the only obstacle from the loan request we get is obviously the property type. Discretionary retail is challenging for us. We pay a lot more attention to location and the tenant. Are they going to be there? What kind of lease do they have? How strong are they? Are the tenants? So we're very conservative in our loan to values on discretionary retail. Hotels we've never done because we never understood them. And I think we're lucky, maybe by design. So we've never lent against them when we're not lending against those assets. We like apartments. We like office building is challenging. Also, location is also very important. And the type of, and loan to value. These are really the only challenges and obstacles we see when we have a loan request from a borrower. Our borrowers are usually high net worth. They're savvy, smart real estate investors and developers. We're really not a hard money lender. We're obviously higher than banks in terms of rates and lower than most hard money lenders. We shy away from hard money practices, high fees, points, rates. We have no prepayment penalty. We, in fact, encourage a borrower to pay us off so we can put it into a new project.
Mm-hmm.
And
So Rob, Eric,
I'd kind of see the same thing. There's a couple constraints. One of the constraints is sourcing. As Nick said, we can find garbage all day long. It's really easy to find garbage. And that's what has really led, some of our other competitors to struggle is we go out and we meet the borrowers. Our sourcing process is really quite labor intensive, whereas other people are going to, buy leads off the internet and those sorts of things. So one of our constraints is the labor intensive nature and finding the good deals. And then, another one, we're 6-month loans, we're 6 to 12-month loans. So we're always on the treadmill. So if we slow down, if we can't find things, those sorts of things, we're a 6-month loan. The good thing from an investor point of view is our portfolio just, bleeds off and it pays out within 6 months, and you're still going to get return of capital and most likely a return on capital, most highly probable a return on capital. But that's, I think, really the constraint for the industry is sourcing. Underwriting is a problem. Then there's something, underwriting is a problem that everybody kind of does and has their way of looking at things, and actually probably does a relatively good job. And then other things, the portfolio servicing and portfolio construction, a lot of people allow somebody else to do that. We think that that's a major problem, but those are issues with individual business models rather than the industry as a whole. The other big problem for ours is and we just think that there's really low risk of this happening, but if the regulators decide to come back in and somehow allow banks into this or regulate us some other way, that would slow us down.
And from my perspective as an institutional investor, you got to look at, gain initial investment into the direct loans, but it's later on what's going to be the issue. Are these businesses viable? Can they continue to meet their projections that they initially provided us and to the various funds? And then looking at the debt service ratios down the road, everybody says, okay, we're in a difficult time and we got a lot of stimulus money coming in, a lot of tax incentives, and we're all in this together, mentality right now. But down the road, it's going to ease up. The Fed is going to change. There's going to be Washington policies that are going to be changing in the near future potentially, and then you kind of, as the economy hopefully improves and we come up with a cure, will these companies be able to survive? If there's that potential of, we might be a second wave, which, the health departments are predicting, what's going to happen then? Is it, will there be more lockdowns, and that'll put more stress on organizations? And even as companies who we might be lending to, their models are going to be changing. Everybody's working remotely now. Now you don't need as much individuals, in the office, and how can you, and using technology to become more efficient. In a sense, your companies are getting more efficient, and that has a downward effect with the employees. They're going to potentially continue to have a high unemployment rate or under workforce, and that's going to impact, who's going to be spending their money and where they're spending the money. Are they going to downsize their homes? And so there's a lot of different areas that potentially down the road can be challenging for us to face.
Yeah. So, and continue on slightly the same topic. And Nick, you already talked about some of the metrics you look on during your underwriting process, your loan to value, your locations, and so on. So if we look about the credit risk and the evolution of credit risk, especially given the current situation with COVID-19, Nick, I'll start with you. Like, how is Keybridge evaluating commercial properties? Has the strategy changed?
Well, our strategy has always been the same. We're just being more conservative this time around. We rely on years of experience through several major economic cycles with supporting data on comps, property types, borrower profile, area economics, and demographics, and exit strategy is really what we look into when we start underwriting loans. Look, in a few minutes, we think we can determine whether we should proceed with a loan request or where it's not a deal for us. If it's a purchase transaction and if the deal is negotiated by two commercial real estate brokers, the notion is that they arrived at the fair market value, and we'll test that. We look at other people's appraisals, but we have a very seasoned evaluation team, and we determine our own value based on what we think the property is worth. In a refinance situation, when a borrower comes to us, or most of our deals are, I want to say more than 90% of our deal flow is through commercial real estate brokers. And the rest, I want to say CPAs, trusted advisors, attorneys, and people. I've been in the same location for almost 30 years, and people do know of us. So we hardly have to look for any new deals. So most people know how we underwrite and what we look for. They know that we are not more than 50%. We don't like to be more than 50% loan to value, and there's plenty of properties out there with plenty of equity in great locations that they're not able to go to a traditional bank, and get a loan on a timely fashion. And for us, it's like once we know where the property is located, we usually within a few days have an opinion of value. And if it's a refinance, we ask questions. When did you buy the property? What did you pay for it? What do you owe on it? What is the purpose of the loan? It's very important to us. Yes, we are a private fund, and yes, we can move forward, but it's quickly if we decide it's a doable deal for us. And history has shown us that when people have skin in the game, when you have plenty of equity, you're going to hold on to that property. So the risk is very limited when you make low leverage loans for borrowers and for the lenders. Let's say in 1 year our loan is due and the borrower wants to extend. If you think the value is still there for us, we'll extend that loan for another year at maybe a little bit slightly higher rate. We'd like to stay between 7 to 9%. That's really our target. So for investors who want double-digit returns, they're not our investors. They probably want to take more risk. We stay away from risk. The most important thing for investors is safety. And we safeguard the investments of our investors. That's really our primary focus. And there's plenty of our business in California alone for us. We will be looking into other trust deed states because we're familiar with trust deed loans. We're not really familiar with mortgage states, and we're going to shy away from those until we really understand that.
Mm-hmm.
But I want to say more than 100% of our activity is California and coastal counties for 2020. It's the area we're intimately familiar with. From San
Fantastic.
Francisco to San Diego.
Yeah, thank you, Nick. Rob, similar question to you, right? About your current underwriting standards, and actually maybe an extension of that question would be: do you see underwriting standards tightening as a result of the COVID-19 pandemic?
Yeah, throughout the industry, and for us certainly, standards are tightening. And really, it's there's kind of two pieces of that. There's stuff that loans should not have been made in the past. We agree 100% that skin should be in the game, and that people act much more rationally and much more consistently with our goals when they have skin in the game. And so a lot of loans in the past were made without skin in the game. Those have really evaporated. We're starting to see those come back just a little bit. Those 100% loan to value or loan to cost loans, those are a really bad idea from our perspective. So we're seeing those as far as our portfolio goes. Yeah, we have tightened up as well. And really what this has given us the opportunity to do is to up our borrower profile. So what we really want is we really want the experienced guys, the guys who have done this multiple times. They have a process. They know how to plan. They know what goes wrong. They know what to look at. They are not, watching HGTV for inspiration, those sorts of things. They know where to pay money. So they generally pay a designer. These are guys that swing hammers, and they don't really, they're not interior designers, so they pay for an interior designer. A casual person's not going to do that. So we're looking for more of the experienced borrowers. And that's given us that opportunity really. And we've looked at, we've kind of gone through, okay, what did we learn? And we've been looking at for a slowdown since third quarter of last year. And for anyone who kind of wants to look at, beyond our experience, there's a great piece, Trammell Crow's 1989 Lessons Learned in a Down Market. It's 100 and some odd pages of them going through things that they had learned. We've gone through things that we've learned. We've done the same things. We used to do much more out of state. That's why we're now focused much more on Colorado, Arizona, and Texas. We did do some broker loans. We probably had, maybe 5% or so of our portfolio that we purchased from brokers. That we have been reminded again is a bad idea. We are not using brokers at all. We are shying away from the first timers, the hobbyists, those sorts of people. We've lent to them in the past. We'll continue to lend with them if we can get the loan to values right, but they are in a different tier. And we, like mortgage states, we do not like the trust deed states. So there's an opportunity for plenty of us in this. And we don't like the judicial. The judicial states are the states that are really taking much, much longer to resolve any sorts of things. The problem in the how you really kill your returns is cash drag. And anytime you've gone into foreclosure or forbearance or any of those sorts of things, you end up with a cash drag on the portfolio. So the judicial states represent much more cash drag.
Thank you. All right, I'm going to ask maybe the three of you to put your wizard hats on and look into the crystal ball. And we got a question from Gordon. Where do you see loan borrowing rates and loan to values in 2021? Any takers?
I'm sorry, Eduardo, what was the question again exactly? Sorry. didn't
Where,
hear you.
where do you see borrowing rates and LTVs in 2021?
Well, it depends what asset class. We're a commercial real estate
Absolutely.
lender. So LTVs, we want to stay below 60% in prime locations. And we want to be ready for any corrections or even steep decline in real estate, commercial real estate values. I think residential real estate values are going to decline as well. You know, when you have many people out of job, when the Fed stop, you know, pumping money into people's account, which is going to end soon, we're going to see a different world, I believe. So there is going to be less demand and less people qualifying to acquire properties. And that is going to have an impact, commercial values on real estate. And commercial, it's really income producing. You know, are landlords going to be able to collect the same rent per square foot that they used to collect last year, just 6 months ago? I don't think so. Our tenants are going to be able to stay in those properties. If more than 10% of your gross revenue goes towards rent on a commercial property, you're having problem. Now think about all these restaurants where now they're going to have to go to practice social distancing and maybe occupy only 60% of their seats. At 70 to 75%, you're breaking even. They work on thin profit margin to begin with. So the reality, we haven't felt yet the impact of COVID-19. And why? Because of the injections of money into people's account. The stock market is giving a lot of people hope. Yes, there is a lot of money in the market. But I think in terms of value, Eduardo, you ask a very good question. We have to deal with this issue all the time when we underwrite loans. Where are we going to be in a year from now? Where are we going to be in 6 months? And we think the values are going to come down because income has a direct impact. Net operating income, or NOI, we call it in commercial real estate, has a direct impact on income, on value. So cap rates are going to go up, I think. We've had the lowest cap rates in the coastal counties of California. Properties were being traded at a 3% cap rate. That was crazy. That means 3% cash on cash. And even after you bought the property, you realized you were really not at 3% after 6 months of operation. So we're going to see cap rates go up. We're going to see values going to come down. That's why we have a cushion. We built a cushion in our loan to value at 50%. We go up to 60%. If it's super prime location, really very strong borrower and very good tenants. So we're buckling up our seats. And that's all I want to say for now.
Fantastic. Rob, Eric, anything to add on that?
Yeah, we're loan to values in the single family residential. You know, you have to talk about loan to cost versus after rehab value. After rehab value, in the neighborhood of 65%. Some people are doing a little bit less. Loan to costs are going to be for the commercial. What really happens is going to be in the 80% or so. And you have to think about, you know, how do you reconcile those two? You have to think about the J curve. The first thing that many people are going to do with it depends on the type of loan they're doing and those sorts of things. But the first thing that people are going to do with our asset is they're going to diminish the value of it for a little while they do demo and those sorts of things. So the first thing that happens to our collateral is it goes down in value before it goes back up. So we need to make sure that we've constructed a portfolio consistent with not having our entire portfolio at the bottom of the J curve. And then how deep is that J curve? What's the timing of that J curve? How all of those sorts of things. So that's why the loan to cost is going to be 80%. Generally, the J curve, the bottom of the J curve is going to be more in the neighborhood of 10%. So we've got a little bit of a cushion there in case things go wrong. As far as rates go, you know, you see teaser rates all the time, sub 10%. This is for single family residential, not commercial. Commercial is going to be lower. But by the time you load in fees and all that sort of stuff, a normal borrower is paying in the neighborhood of 10 to 12%. That's the way we do it. We do very transparent pricing. Other people do different models, but you really have to consider fees, and segments really matter. So, commercial real estate is going to trade at a different rate than obviously a single family residential. California, the rates are much lower overall. There's
Rob, there's something wrong with your microphone.
Yeah, Rob, your audio just changed.
Am I back?
No, it still sounds a little distant.
Is that any better?
Perhaps.
All right. Well, the segments are going to matter.
It is
So
better.
California is lower yields overall, and you're going to want to look at some of that other stuff, some of the other
Great.
segmentation.
Thank you very much.
Jeff, if I may quickly add that hotel delinquencies are 18% up. Retail delinquencies, 10% up. 4.3 million people, homeowners, are 30-day delinquent. So will that have an impact on values? Absolutely.
It also depends on the borrower's credit. You constantly have to reevaluate where they are in their own situation. Are they workable? And if you're giving them lines of credit, you know that if they're suddenly tapping them, pulling out the cash, they're probably going to either build up their cash balances as a defensive mode, or they really need the money. And at some point, there's going to be a snowball effect. If they can't, they go too extended, they're going to end up being delinquent, delaying payments, possibly defaulting and having other types of downturns. So when we're looking at borrower lending, you have to constantly, evaluate the portfolio where you want to be in the structure. If you're in a more senior level lender, then you're not going to get as much return, but you also know you're higher up if you're on getting your return if they go into a distressed situation. And then there are, if you invest in distressed funds, their purpose is to take on the more risk, look for more opportunity investments, and you're going to hopefully get the returns that will reflect that. So it all depends where the person, the company, is on the credit cycle, and how one's portfolio is doing. If you have a lot of exposure and you're in the plans and the funds are experiencing a lot of stress, you're going to suddenly tighten up on your lending. If you're if you gain good cash flow and said, okay, we know, and the stimulus continues, you say, okay, sometimes the regulators say give the incentive to continue lending, and if they're going to be backstopping certain assets or certain loans, just to get you to take on the risk to get the money flowing, you end up doing it that way. And even different areas of the country or different parts of the world, it's all, initially we're all in this lockdown, but over time, as things open up, some areas are going to do much better than others, and some are going to go backtrack, and it's just a matter of where there are their opportunities.
So talking precisely about that, Eric, and we'll do another round of answers before moving on to the Q&A session. But so, Eric, where do you see the opportunities to achieve risk-adjusted yields given the current low yield environment?
So I look cross borders. If you look around the world, right, it's the central banks have lowered the interest rates to some areas negative, right? Germany is, rate the 10-year bond is at negative 0.43. Switzerland is negative 0.5. Netherlands is 0.2. U.S. 10-year Treasury, which is pretty high compared to that, is like at 0.75%. If you're looking at the emerging markets, the India, their 10-year bond is at 5.84%. And then Mexico is 6% and Brazil is 7%, but those have a lot more higher risk. And looking at opportunities, I'd say data centers and cell towers. You're seeing that, as we're all suddenly had to come to a hard stop and leave our offices to suddenly work remotely, the national infrastructures isn't necessarily up to date. And so there's going to be a tremendous amount of investment going forward from the various stimulus programs. There's earmarked trillions of dollars for infrastructure investments and technology for the various national grids, and not just in the U.S. but globally. All the big national big countries are doing this because they know, it's a great opportunity. You spend money in infrastructure and you can get things going. It creates jobs, it creates efficiencies. And that's where I think there's going to be a tremendous amount of opportunity is in these new areas of real estate, not necessarily new, but things that they're going that make the investment now, they're going to be paying off for a very long time. And as I said, data centers and the industrials are we're looking at currently.
Yeah, thank you, Eric. Yeah, that's in line with what I said earlier, also about the S&P's research, right, pointing out to how data centers are faring quite well actually during this time. Rob, how about yourself? Where do you see opportunities now? And maybe you want to touch upon also briefly on advantages of a fund structure.
Yeah, so our not to sound too boring, but we're plenty busy where we are. Arizona, Colorado, and Texas, single family residential, doing a couple things in other states. We've got about 21 total states. So we're plenty busy with what we've got. So those are the opportunities that we see. Touch quickly on, Eric made a really important point, which is the balance sheet of the entire borrower matters. And that's important to him. It's also important to us, and one of the things that we've got to make sure and look at. As far as the advantages of a fund structure, really, a couple different things. The returns are important because, and really the big thing, about 50% or so of family offices and probably a number of others actually do direct loans on the side, whether it's commercial or whether it's single family residential. And which is great, so you can get our gross return instead of our net return. But that money is not always deployed, whereas with a fund structure, the money is always deployed. So if your money is not deployed for a couple months, whatever advantage you have, gross versus net, evaporates. Another reason is just convenience, right? We do all the paperwork, the filings, those sorts of things. We are structured as a REIT, so you get the cash, the tax advantage of those sorts of things, which you can't do on your own because of the restriction relative to how much of it you can own personally. And then the portfolio, you get a portfolio benefit because something will go wrong with your portfolio. Again, we're kind of 1% at any given time. At any given time, we're going to have a 1% issue at any given time. Probably around 5% of our portfolio has some sort of issue. Those just take a lot of time to deal with, and we deal with those. We know how to deal with those, and you get a portfolio effect rather than a single asset problem. So those are some of the advantages of a fund structure.
Thank you, Rob. Appreciate it. Okay, so now we've come to the Q&A portion of the webinar, and we thank everybody for submitting the questions. Please do continue to submit questions as we answer them, and we'll try to get through all of them. We had a question come in earlier from Phil about the situation that we're experiencing now, right, with COVID-19 and the economic recession. What are some differences between what we're seeing now and what we saw during 2008-2009 period?
The major difference, I want to say that 2008 was really a banking crisis. This is way different. This is a global pandemic problem that really pushed the economy off the cliff and everything alongside with it. We didn't have 40 million unemployed in 2008 crash. So that's really, I want to say, the major differences. Major difference between the 2008 banking crisis and this is now a pandemic crisis. We've never experienced anything like this ever no, in living memory, none of us. So it's hard to predict. There's really no blueprint to this. The feds are trying to use what they've learned from the 2008 crash. And for the very first time, Jerome Powell said the Fed will do everything in its power. And that's a very strong statement. Gave a lot of confidence to the market. That's why you see the stock market reacting the way it's been reacting. The stock market, I don't think, should be trading at 26, 27,000. So that's really another factor to consider, is the power of the Feds. And because of that, it's really not clear as to how soon this thing is going to be normalized. And we go back to an economy that we were all familiar with. These are the hard questions for everyone. And since there's no blueprint for it, we have to wait and see. And that's why I think, being conservative in underwriting, if you're managing a debt fund, the asset class, luckily for us, we have no toxic asset. It's a clean fund.
Yeah.
Okay, thank you.
Thank you, Nick. Actually, you talked about the quality of underwriting, and there was another question coming in here from Will, directed to Rob. And I think Rob might have something to say about the underwriting quality. Burang mentioned that he has only 1% default rates. Given that standard default rates are 2 to 3%, and you are originating hard money loans, which are generally considered higher risk of default, I wonder if you can give some perspective on why your default rates are so low. I've heard many business purpose loans investors are experiencing greater than 10% default rates already. So Rob?
Yeah, the short answer is we do things differently. The 10% in our industry, and I don't know about the other industries, but in our industry, there were a couple large players that were going in. We're at 10% default-ish rates. There's a variety of reasons. We think that they probably had that. They were buying. They were buying stuff off the internet. They were mostly involved in secondary markets. They were really trading a spread game versus trying to originate their own, service their own, construct a portfolio. So that's how you kind of get to the 10% tier. As far as the 2 to 3%, again, I would say at any given time, as far as sort of in some area of impairment in our portfolio, we're probably at 2 or 3%. As far as realized, we're at 1%. And I would say, really the way that we get from that impairment rate to a pretty good, something we're comfortable with 1% rate is we service our own loans. And we do think we do a pretty good job. I will point out that there are others in this space that we have respect for, that are also that we think their business models are good, they're sharp operators, those sorts of things, and they're also down at 1%. Happy to share those with you, offline.
Thank you, Rob. I appreciate it. Okay, we have another question that came from Miguel, and it's a topic. We touched upon it briefly already, but multifamily has so far performed well post-COVID, or I guess during COVID still. What's the impact expected once extended unemployment and eviction moratoriums wear off, again, on the multifamily space? The question for anyone who would like to answer.
Eduardo, I'm sorry, you broke. I didn't hear you. I may have a problem with my microphone. Could you ask that question again one more time, please?
Sure. Yes, I hope it is not my microphone. The multifamily has so far performed well post-COVID, and what is the impact that we expect once the extended unemployment and eviction moratoriums wear off?
Well, the impact is obviously not going to be good. Multifamily typically through every cycle has been outperforming other asset classes. But our concern is that in areas where, rents are expensive, certain areas $4 to $5 a foot, or $3 to $4 a foot, and where most people were spending more than 50% of their gross monthly income on rent, is going to have a huge impact, I think. I think just like any other asset class is going to experience some tough time ahead. It's going to take some time before landlords and tenants and are going to be familiar with the reality. And if I were just to predict and guess, I would say by the end of this year, we're going to see some sort of adjustments. Landlords going to have to deal with the reality. Can most, or I don't know most, but can every tenant pay the same rent they used to be? It's going to be challenging on every asset class, I want to say, including apartments. But apartments, it's a roof on your head, and it's the last thing you want to let go, I think.
Yep. Exactly. Yeah, no, absolutely. When I used to do modeling for stress testing for banks or something, we always included that in our reasoning as well. All right, we have another question from Shetty saying, do you expect a shift in? Sorry, 1 second. Let me move. Okay. Do you expect a shift in supplying real estate assets because of the pandemic? And how do you see that affecting real estate prices? Open question.
Well, we talked about that a little bit. It's more of a seller strike. So absolutely, volumes are off. Buyers are less interested, fearful, those sorts of things. Absolutely. But more than that, it's a seller strike. We think that some of that volume will come back online, just as sellers, get comfortable with how to show their properties and those sorts of things. We also think that supply will come from some of the the weak hand holders, whether that's investors or tenants, normal borrowers. Equity going in was pretty high, so that may be a little bit less. But that's really why we see volumes off. Is it's an issue on the seller side, not on the buyer, less so on the buyer side.
Great, thank you so much. All right, I would like to be cognizant of the time. I know Flya spent a lot of time preparing a fantastic event for everybody. So we've reached the end of our panel. Thank you for submitting the questions. In the coming days, we will do our best to answer any questions that was submitted that we didn't get to answer now, okay? And I know the panelists look forward to reviewing any unanswered questions. We thank you for your time and participation. Please join me in extending a warm thank you to the panelists, Rob, Eric, and Nick, and to Flya for organizing this fantastic event. Thank you very much.
Eduardo, thank you very much. Nick, Rob, Eric, thank you very much for presenting today. It was an excellent panel. Thank you for your insights. With that said, I want to thank all of our sponsors, Nationwide, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Entrust Global, Off the Chain Capital, Clarion Asset Management, for helping us to make this event today possible. Without your help and support, there's no way we would have been able to put this high quality event together again. I also want to thank all of the members of Flya and our board for their support during these challenging times. It's amazing how this community has come together to provide thought leadership during great uncertainty. It makes me proud to be a part of this group. Really quickly, because we're a minute behind schedule, we're going to host this event again, part 5, on July 15th and 16th. We decided to not do the event in New York City because of travel restrictions. But we did, because of the demand, decide to do a 2-day event for Pot 5, and we'll be sending out updated instructions for that. So I'm very disappointed that we weren't able to do this event live in New York City, but it's definitely with great prudence, that we've come to this conclusion.